My name is Rick Happle, Portfolio Manager at Jaffe Tilsham. Thank you for watching my video recorded on September 1st, Investment Experience Matters. Today I'd like to offer some thoughts on my view of the market over the short term, intermediate term, and long term. Short term, days and weeks. Market momentum looks really good, and that's kind of surprising to me actually. It looks like the market will push higher. And the reason for this is bad news is good news. We had some really weak employment numbers come out. Wage growth is slowing and unemployment is rising. But September is seasonally the weakest month of the year, and we could be just one headline away from bad news becoming bad news. Intermediate term, weeks and months. The S&P 500 is overvalued at 25 times earnings. But if you remove the 7 largest companies from the S&P 500, you're left with 493 that are trading at a multiple of about 16 times earnings, which historically is a fair valuation. A market can be overvalued and correct this valuation in different ways. One, it could correct through price, which is a decline, and we're all familiar with that. It could correct in time, and time of sideways trading is referred to as a consolidation period, where the market just goes up and down and doesn't really make any forward progress or doesn't decline. And the other way is that the market can rotate, and it could rotate to where valuations look more attractive. And I see a market rotating, and one of the strategies from the past that I want to mention today is the bridesmaid strategy. And what the bridesmaid strategy says is don't put all your attention on the bride, focus on the bridesmaid, focus on number 2. And today that would mean reducing your allocation to technology, and would be focusing on 2 sectors in particular, energy and industrials, which are in a virtual tie for second place. I also see improvement occurring in the commodities markets and also in small cap stocks. Longer term, months and years. As a trend follower, you learn that interest rates and inflation are the longest term trends in the market. And the reason makes sense. It's government policy that influences these two markets. And with that said, the Fed is not giving up on 2% inflation. And they don't even need any more interest rate increases. Going from 0 to 5.75% over the past 18 months, all we have to do is just keep rates at this level for a longer period of time. And when I say long, over the past 100 years, there have been periods of S&P performance where it's gained 13% annually over a decade, and other decades where it's only averaged 3% for the entire decade. And I'm concerned that we could see a decade of lower returns. One of the other reasons for that is with falling interest rates since 1985, we've seen 40% of stock market returns attributed to that decline in interest rates. So with a 10 or 11% average return, if you reduce 40% of that, that's where I come up with lower investment returns, which, with that in mind, I'd like to feature 2 of my 8 investment models today: rising dividends and equity premium income. Rising dividends is a basket of approximately 30 stocks with above market dividends that should be able to increase. This portfolio is attractive because you can live off the dividend income and likely see that income increase over time with the rate of inflation. The second model, equity premium income, or EPI for short, is focused more on cash flow than growth. In addition to owning sectors, currently 50% of EPI is in utility stocks, consumer staples, and healthcare. All three pay attractive dividends, but what I do in this model is, in addition to the dividend income, I also sell options, or I sell future growth to a speculator that pays us a premium. So I can take an attractive income from dividends and virtually double it with the premium that I'm receiving from selling calls. This would be a solid recommendation, in my opinion, for pre-retirees preparing for retirement. And the reason I say that is you want to shift away from being a growth investor while you still have time, if you're 3 to 5 years away from retiring. Don't reach for 20% returns at this stage in your life, and here's why I say that. If you have 4 consecutive 20% returns, up 20, up 20, down 20, up 20, you're only going to average 8.5. So don't reach for high returns in this market. Valuations are not that attractive for the S&P 500, but for an active manager, the other 493 stocks offer good opportunities. Finally, investors should remember what my mentor taught me 39 years ago. Watch which way the government is leaning and lean with them. Don't fight the Fed. Experience matters. Thank you for your time today. If you would, please consider a second opinion on your investment portfolio. Thank you.